Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 12th July 2024, and joining Lee to pose some questions on the financial market themes for the week ahead is Jack Greenslade from the Global Customer Marketing Group. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi Lee, how are you?
Hi Jack, good, thanks. Yourself?
Yeah, good, thank you. It's been a big week this week, not least because England made it to another European final. Been quite busy in the markets as well. So, we saw quite a big dollar move off the back of yesterday's CPI and today's PPI data prints. Spot markets pricing in closer to a 90% chance that the Fed cuts rates in September. Do you feel that a rate cut could occur then, or is your forecast unchanged?
Yeah, no, we were looking for a rate cut in September before the CPI report, and certainly that CPI report has reinforced our confidence that they will start to cut rates in September. Our US rate strategist has even highlighted the risk that if we were to continue to see such weak CPI reports in the next couple of months, the Fed could be under some pressure to deliver even a bigger rate cut than a 25 basis point cut in September. So to us, we still feel that there is room there for the US rate market to price in more aggressive pace of Fed rate cuts over the next 6 to 12 months. And that move lower we're seeing in US yields is feeding through to a weaker dollar, which has been our kind of outlook for most of this year.
Yeah, and just speaking on inflation, what do you make of the steep rise in the Shanghai Freight Index late? And obviously, much was made of that rise in shipping costs, in the initial spike of inflation a few years ago. So, is there the possibility this could feed through and lead to higher inflation costs once again?
Yeah, well, we need to keep an eye on the chances there that input costs will pick back up again, particularly on the shipping side and potentially in commodity markets. Obviously, today we did see some upside surprises in the PPI data from the US. So that's just a kind of timely reminder that it's not necessarily the case that we will continue to move lower in inflation in a kind of one-way direction. There can be kind of setbacks along the way, but our bigger picture view is still the same, that we do think we are seeing a rebalancing in labour markets with the demand and supply becoming better balanced. We do think that inflation pressures from the labour market are diminishing, with wage pressures more likely to slow going forward. And we think that eventually will start to feed through as well to more of a slowdown in service sector inflation, which for major economies is the most important component. So to us, we're still confident that we are heading towards slower inflation going forward, and that supports our long-held view that we think central banks can continue to cut back the amount of policy tightening that's in place.
Save for, of course, the Bank of Japan, and that kind of leads me to my next question. Really, we've seen quite a move in dollar yen this week as well. How have our forecasts changed for that pair going forward, given what we've seen?
Yeah, obviously we did see a big move lower for dollar yen after the US CPI report, which it certainly looks like that was intervention from Japan. We had the release earlier today of the latest current account balance data from the BOJ, and that does indicate that Japan looks like they intervened by about 3.5 trillion yen to support the yen. So that's had the kind of similar kind of price action impact that we've seen during previous periods of intervention. It's pushed dollar yen down by about 4 big figures. Obviously, in the past, as we look back on all of those occasions, it wasn't enough to kind of trigger a sustained reversal lower for dollar yen. So for us, we're not convinced that this is kind of the turning point for dollar yen at this point, although we do think we are getting closer to dollar yen peaking out. The fundamental picture is starting to turn, like you say, with the US inflation data becoming more compelling and pointing towards more of a slowdown there. And the Fed, we think, will start to react to that and cut rates at least 2 to 3 times in the second half of this year. In those circumstances, we could start to see dollar yen peak out through the second half of this year.
Yeah, and just onto another theme that seems to have been simmering along in the background. The US fiscal deficit Obviously, Donald Trump is looking more and more likely to become the president after the gaffes that we saw in his speech to NATO, and doesn't seem to have any plans really on raising taxes to fund it. How do you think that will play into the Treasury market, and do you feel that this theme might weigh on yields and the dollar going forward at all?
Yeah, well, certainly if we look at the budget deficit position of the US government, it certainly is unusual in that we have had quite a strong period of economic recovery over the last couple of years. And even though we've had that strong period of growth, the budget deficit has remained relatively elevated at around 5.5% of GDP. So obviously the government there doesn't appear to be any kind of strong plans either from the current government or, like you say, Trump to really kind of put in place much more significant fiscal tightening going forward. So it's more of a hope really that the strong growth will continue in the US and that will lead to further narrowing of the budget deficit. Obviously the Treasury market is nervous over the possibility of further deterioration in the budget deficit. If Trump was to win and the Republicans were to take control of Congress, that could be seen as more inflationary, both from a kind of trade protectionist point of view, but also the potential there for looser fiscal policy and lower taxes to remain in place for longer. So that could pose some additional upside risks for Treasury yields. But like I say, for the dollar, it's not so evident yet really that the kind of size of the US fiscal deficit, that doesn't appear to have significantly had a negative impact on dollar performance. If anything, you could argue that if the Fed has to keep policy tighter for longer because of the looser fiscal policy stance, potentially under a Trump administration, and because of potentially higher import costs because of higher tariffs, that ultimately could mean that the dollar remains stronger for longer, even if the budget deficit is going to remain at higher levels as well.
Yeah, really interesting. And I guess my usual question to you, are we recommending any trade ideas this week?
Yeah, we are kind of maintaining our long Australian dollar trade recommendation against the US dollar in anticipation that the RBA might hike rates again over the summer in response to the higher inflation prints we've had recently in Australia. Whereas the US dollar, we feel, can still weaken further going into the summer period now, with the market becoming more and more confident that the Fed's on track to start cutting rates. We've also recommended a new long sterling stocky trade in our weekly today. We do feel that there's still potential there for the pound to continue to strengthen. It does have the most upward momentum at the moment amongst G10 currencies. And we feel current conditions are favourable for carry trades, and I think investors are increasingly happy to take on the higher yields on offer in the UK, particularly with political risk now more of a back burner. Whereas in Sweden, we think the Swedish krona can weaken further in the near term. We think there's certainly stronger fundamental grounds there for the Riksbank to keep cutting rates more quickly than the Bank of England, and we're expecting at least 3 more cuts from the Riksbank through the second half of this year.
Well, great to speak to you, Lee, and thanks very much.
Thank you. Have a good day.
You too. Cheers.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets research team.